TSS and BTE have joined forces.
Context.
Power.
Edge.
The new paradigm of trading.
Hello, TSS traders. We've prepared a summary of the past week for you. Usually when we talk about a medical diagnosis, there's this expectation of clinical precision.
Right. Yes.
Like you break your arm, the x-ray shows that jagged white line, and the doctor just points to the screen and says, well, there it is. That's the problem.
It's clean, it's binary. I mean, we naturally crave that kind of visible, easily categorized reality where cause and effect are perfectly aligned in a neat little box.
Yeah, exactly. But then you step into the world of market structure and macroeconomics, and suddenly that x-ray machine is completely broken. We are looking at a diagnostic landscape for the stock market this week that is, frankly, really murky.
Diagnostic muddy waters is probably the best way to describe it.
Yeah, we have a massive stack of source material today. It's a full week of AM and PM notes from Spot Gamma covering Monday, April 27th through Friday, May 1st, 2026.
And our mission for this deep dive is really to unpack a week that was absolutely defined by extreme, just almost head-spinning contradictions.
Oh, they really don't make sense on the surface. If you isolate the fundamental inputs of the global economy over these past 5 days and then compare them to the mechanical outputs of the S&P 500, they simply do not appear to belong to the same reality.
No, they don't. You have the tangible physical world of raw commodities, energy supply chains, and international conflict flashing massive warning signs.
Right.
And that is completely juxtaposed against the digital, future-facing world of silicon wafers and artificial intelligence, which is just screaming at capital allocators to buy everything in sight.
So let's just set the scene for a moment for you guys listening. On one side of the ledger, you have severe, rapidly escalating geopolitical tensions. We're talking about a major fluid situation involving the U.S., Iran, and the Strait of Hormuz. And that sent global oil prices absolutely parabolic.
Yeah, just massive spikes.
But on the flip side of that exact same ledger, you have an absolute relentless euphoric bid in technology and semiconductor stocks. The market is effectively trying to inhabit two separate universes simultaneously.
It really is.
And here's where it gets really interesting. Despite this massive known, unknown geopolitical risk unfolding in real time, right in front of everyone's screens, the VIX hit post-war lows.
The premier fear gauge, yeah.
Right. We saw it dipping down into the 16 to 17 range. I look at that and think, how is a VIX of 17 even mathematically possible when the front pages of every global newspaper are flashing red?
Well, what's fascinating here is that the initial instinct is to assume the market is just being stubbornly naive, right? Like traders are just burying their heads in the sand.
Which is what everyone says on Twitter.
Exactly. But the data we are parsing through suggests something much more complex. The market isn't ignoring the risk out of blind optimism. It is structurally positioned through the massive architecture of options gamma to absorb it.
Okay, so the plumbing of the derivatives market is acting like, what, an industrial-grade shock absorber?
Basically, yes. If we want to understand how this week played out, we have to look past the geopolitical headlines and get our hands dirty in the actual mechanical plumbing of dealer positioning.
Okay, let's unpack this from the ground up. Because before we get into the individual stock mechanics, the call options, the algorithms, we have to establish the sheer weight of the macro environment.
Yeah, establishing that baseline of risk is crucial because the lack of downside reaction is really the central mystery of the data set.
We need to talk about the events that fundamentally should have derailed this market, but somehow failed to leave a scratch. Looking at the early week data, the geopolitical backdrop was incredibly heavy.
Very heavy. There were intense reports of alleged talks between Iran and the U.S. on Monday and Tuesday.
Right, floating a proposal to reopen the Strait of Hormuz and defer the broader nuclear file. The notes detailed mentions of J.D. Vance, Witkoff, and Kushner traveling to Islamabad on Tuesday for a second round of high-stakes talks.
And we should pause right here.
Yeah, let me make something explicitly clear for you listening. We take absolutely no political sides on this show. We are objectively reporting on these political developments and these specific figures purely as market catalysts.
That is a vital distinction to make. In the context of institutional trading, these names, locations, and negotiations are stripped of their political weight.
Our only focus is analyzing how the probability of these headlines coming to fruition impacted the energy and equity markets.
Right. Traders are just pricing the odds of a supply chain disruption. And the probability of a peaceful resolution seemed to evaporate almost instantly.
Because by Tuesday, the data noted that those alleged talks were reported canceled.
And the oil market's reaction to that cancellation was violent. We saw massive, sustained swings. WTI and Brent crude were both climbing steadily as the week opened.
But then by Thursday, after news broke of potential port blockades, with reports suggesting preparations for an extended blockade of Iranian ports, Brent crude spiked to a 4-year wartime high.
It touched $126.41 intraday before eventually fading back to around $114.
And WTI was hovering up around 105.
Those are staggering prints for global energy markets. I mean, a $126 print on Brent crude isn't just a headline, it is a systemic macroeconomic shock.
So to understand why a number like that traditionally terrifies equity bulls, we really need to trace the economic transmission mechanism. Like, why does oil rocketing past $100 normally trigger a violent bearish repricing in the S&P 500?
It's a very predictable chain reaction, honestly. Let's trace that chain. Because to the average person, high gas prices just mean a more expensive commute.
Right. It costs more to fill up the tank.
Exactly. But to an institutional portfolio manager, it means something entirely different. When the price of crude oil spikes violently, the cost of literally moving the global economy spikes with it.
So transportation, shipping containers, manufacturing.
Yeah, agriculture, the creation of basic plastic goods, the input costs for all of these surge, and that is the purest, most undeniable form of inflationary pressure.
And when inflation rises, or critically, when the bond market's expectation of future inflation rises, central banks are backed into a corner.
Specifically, the U.S. Federal Reserve. They are forced to hold interest rates higher for much longer than anticipated. Or, in worst-case scenarios, actually hike rates into a slowing economy to kill the demand side of the inflation equation.
And when the Fed holds rates higher, that completely changes the math on stock valuations.
It alters the foundational math of Wall Street. Higher interest rates increase the discount rate that analysts use to value future corporate earnings.
So if the risk-free rate of return on a treasury bond is 5% instead of 2%,
you are going to pay significantly less today for $1 of profit a tech company promises to make 5 years from now. That compresses stock valuations.
plus expensive oil acts as a massive regressive tax on the global consumer.
Exactly. If a family is spending twice as much of their monthly budget just to fill their gas tank and heat their home, they have significantly less discretionary income to buy a new iPhone, upgrade software subscriptions, or shop on Amazon.
So corporate profit margins get brutally squeezed from both ends. Their operating costs go up, and their consumer revenues go down.
It's a double whammy. The consumer's wallet is drained, and the Fed is forced to keep the liquidity spigots turned off.
Historically, oil blowing past $100, let alone touching 126, is a blaring, flashing red light telling you to sell risk assets and hide in cash.
It is the textbook definition of an equity-negative macro shock.
But this is where I have to look at the S&P 500's actual performance and scratch my head. Okay, let's unpack this. If oil spikes to 126, squeezing margins and taxing the consumer, how on earth is the S&P 500 up almost 10% for the month of April?
It's wild. The data highlights this as the best month for the index since late 2020.
The broad market looks like a heavyweight fighter who is just absorbing brutal rib-cracking body blows, but is completely ignoring them because they are so hyper-focused on landing one single knockout punch.
That fighter analogy captures the psychology perfectly. The market is taking the energy spike and the geopolitical tensions straight to the ribs, but its eyes are locked entirely on the tech and AI narrative.
So the perceived reward of the artificial intelligence productivity miracle is so massive that it is completely overshadowing the very real pain of the macro environment.
Yeah, and the data reveals a really intriguing shift in how institutional traders are actually positioning for this bizarre dynamic. We are seeing a breakdown in traditional portfolio construction.
For decades, if you managed a massive long equity portfolio and you wanted to hedge against a recession or a sudden market shock, you bought U.S. Treasuries. You built a classic 60-40 portfolio.
60% equities for growth, 40% bonds for safety and yield.
Right.
The historical assumption being that if equities drop due to a growth scare, investors will flee to the safety of government bonds, driving bond prices up and offsetting the stock losses.
But what we are seeing in the notes is that traders are abandoning that traditional 60-40 hedge.
Yeah.
And it makes perfect sense when you think about the nature of the specific shock we are facing.
Right, because in an environment where the primary risk is inflationary, like a massive geopolitical oil spike, bonds offer absolutely zero protection.
If oil goes to 126, inflation expectations rip higher, which means bond yields have to spike to compensate. And since bond yields and bond prices moved inversely, bond prices plummet.
You end up in a correlation nightmare where both your stocks and your bonds are losing money simultaneously. The 60-40 portfolio suddenly has no place to hide.
So, without bonds as a safe haven, what is the institutional alternative? The data suggests they're moving into a highly unconventional dual trade. They're going long energy and long semis.
It's a fascinating barbell strategy. When you break down the mechanics, it actually reveals a very pragmatic, if aggressive, logic.
Awesome.
Well, you take a massive long position in energy, whether that's direct crude futures or energy production ETFs like XOP, as a direct, positively correlated hedge against the geopolitical tail risk.
Okay, so if the Strait of Hormuz is blocked and supply is choked off, your energy position goes parabolic.
Exactly, injecting massive profits into your portfolio to offset whatever losses you might take elsewhere.
You are explicitly owning the problem. You are monetizing the geopolitical fear.
Precisely. But simultaneously, on the other side of the barbell, you take massive long positions in semiconductors and the Magnificent Seven tech megacaps.
You do this to fully participate in the secular AI growth story, which the market currently treats as an unstoppable force.
Yes, largely immune to the inflation concerns that plague the rest of the economy. The logic is that AI productivity gains will outpace any margin compression caused by higher oil.
You own the problem with the energy trade, and you own the perceived solution with the semiconductor trade. It's brilliant in its simplicity, but there's a massive mechanical catch that the data flags.
The options pricing.
Yes, the semiconductor leg of that trade has gone completely convex to the upside. The options pricing on these tech names has become so incredibly bloated and expensive that the mathematical probability of the trade actually turning a profit for a new buyer has shrunk down to almost nothing.
And that extreme options pricing is the perfect pivot point to examine what is actually pulling this market higher. If macro risks are being neutralized by the energy hedge, what is the engine driving the S&P 500 up 10%?
The answer lies entirely in the concentrated earnings power and the absolutely extreme derivative positioning within the Mag 7 and semiconductor space.
Because we just survived an absolute gauntlet of tech earnings this week. It was a relentless schedule of market-moving reports.
Let's run through the scoreboard to give some context to the volatility. It really kicked off with Seagate Technology, STX. They reported Tuesday night and absolutely crushed estimates, gapping up 17% by Wednesday morning.
Seagate was incredibly important because it served as an early canary in the coal mine for the entire sector.
Yeah.
A 17% gap up validated the bullish thesis that massive capital expenditure on hardware and AI infrastructure was not only continuing but accelerating.
It gave the market the green light to maintain its euphoric positioning ahead of the heavier hitters.
Yeah, and then we stepped into the ring with the true heavyweights on Wednesday and Thursday.
Meta disappointed, dropping 9%. Amazon posted a solid 3% gain. Microsoft dipped slightly, down 2%. Alphabet, Google rallied 6%. And finally, Apple closed out the week up 3%.
When you look at those individual numbers, it was actually a fairly mixed bag for the mega caps.
But the broader semiconductor sector simply didn't care about the mixed results. The data highlights an incredibly revealing statistic. The SMH, the premier semiconductor ETF, was up 9% post-OPEX.
Before we dig into the weight of that 9% move, it's worth taking a second to clarify the significance of post-OPEX for anyone trying to map out market timing. OPEX refers to options expiration.
Right, specifically the monthly expiration that occurs on the third Friday of every month, which in this case was April 17th.
And OPEX is critical because it's a structural reset button for the market. Millions of options contracts expire and roll off the market maker's books. All the hedging that was tied to those specific contracts vanishes.
It unpins the underlying stocks and allows them to move much more freely. It essentially clears the deck for a new trend to establish itself.
Precisely. And the trend that established itself post-OPEX was a relentless bid for semiconductors. The SMH being up 9% over that window was so mathematically powerful that it was responsible for adding 98 basis points of positive performance to the overall S&P 500 index.
Let's do the math on that to really highlight the absurdity of the market concentration right now.
Yeah.
A basis point is 1/100th of a percentage point.
Right.
So 98 basis points is essentially a 1% gain. The semiconductor sector alone dragged the entire S&P 500 up by roughly 1%. But here's the kicker. Over that exact same post-OPEX window, the S&P 500 as a whole was only up 67 basis points.
Which means if you strip out the semiconductors, the other 490-something stocks in the index were actually a net drag of about 31 basis points.
Wow.
Yeah, the vast majority of the U.S. equity market was slowly bleeding out, likely feeling the pressure of those $126 oil prints, while a tiny, hyper-concentrated cluster of silicon manufacturers essentially put the entire index on their back and carried it higher.
The rest of the market is sinking, but the tech raft is so incredibly buoyant it's keeping the entire index afloat. And this extreme concentration isn't just a fundamental earnings story. It is perfectly mirrored and aggressively amplified in the options market.
The spot gamma compass data explicitly maps out this positioning.
For context, the compass is a proprietary diagnostic tool that aggregates options flow to show where institutional money is placing its bets. And the readout for this week was crystal clear. SPY calls were heavily bid relative to puts.
When we say calls or bid, it means institutions are aggressively stepping in as buyers. They're willing to pay the ask price, driving the premium of those options higher.
They are paying a premium for upside exposure, the right to buy the market higher, rather than spending that capital on puts for downside protection.
It is a definitive signal of institutional risk-on sentiment. And nowhere was this bidding war more extreme than in Microsoft leading up to its earnings report.
The data isolated Microsoft 1-month 25 delta calls, noting they were trading at an implied volatility, or V, of roughly 40%.
That is a dense, highly technical metric, but unpacking it reveals exactly how euphoric the market had become. Let's break down the components. Delta, at its core, measures the sensitivity of an options price to a $1 move in the underlying stock.
But practically speaking, traders often use delta as a shorthand for probability.
Yeah, exactly. A 25 delta call has roughly a 25% mathematical probability of expiring in the money. It is an out-of-the-money option. The stock has to rally significantly just to reach the strike price.
So you are basically buying a lotto ticket that only pays out if the stock goes on a massive run.
Exactly. Now add implied volatility to the mix. 4 is the market's forward-looking expectation of how wildly the stock's price is going to swing, and it is the primary driver of an options cost.
Right.
When a 4 sits at 40% for a mature multi-trillion-dollar behemoth like Microsoft, it means the options market is pricing in earth-shattering movement. Specifically, the data calculated that a 40% IV implied an 11% expected move in Microsoft's stock price over the next 30 days.
Think about the sheer scale of that. An 11% move on Microsoft translates to hundreds of billions of dollars in market capitalization being created or destroyed in a matter of weeks.
It's massive.
If I'm looking at Microsoft's options pricing right before earnings, it feels less like a calculated investment and more like trying to scalp a ticket to the Super Bowl at the stadium gates in the first quarter.
Oh, that's a great way to put it.
You are paying such an exorbitant, historically inflated premium just to get in the door that your team doesn't just have to win the game. They have to win by 40 points just for you to break even on the cost of the ticket.
That is the exact mechanical trap that so many retail traders fall into during earnings season. They see a great company, they assume earnings will be strong, so they buy calls. But they fail to account for the premium they are paying.
Which leads to one of the most counterintuitive but mathematically sound trading recommendations we saw in the data this week.
Right, from Tuesday.
Yes. Despite the massive AI hype, the analysis heading into Tuesday explicitly recommended selling AMD 1 to 2 month call structures.
To the untrained eye, stepping in front of the AI freight train to sell AMD calls sounds like financial suicide. But the thesis separating the fundamental company from the mechanical options trade is brilliant.
It comes down to understanding the concept of volatility crush, right, or Vega crush.
Yep. The data identified 2 glaring issues with buying AMD calls. First, the implied volatility on those 25 delta calls had spiked to a 3-year high. Second, the rate of change of the stock's upside momentum was mathematically bound to slow down. AMD stock had already rallied 50% over the preceding month.
So the demand for calls had pushed the IV to its absolute peak right as the stock was becoming historically overextended.
Right. If you run the options math on that setup, because the IV premium is so incredibly bloated, you would need AMD, which, again, just rallied 50%, to rally another 20% over the next few weeks just for that out-of-the-money call to hit its break-even price.
So even if AMD announces fantastic earnings, if the stock only rallies 5%, the person who bought that call loses their shirt.
Because the moment the earnings are released, the unknown becomes known. The uncertainty vanishes, and the implied volatility instantly collapses. That is the volatility crush. The bloated premium evaporates overnight.
By recommending the sale of those call structures, the strategy was to act as the casino. You collect that massive, historically high premium upfront, betting that AMD won't be able to deliver the 20% miracle rally required to make those calls profitable.
If the stock stays flat, drops, or even rallies slightly, the IV crushes, the calls expire worthless, and you keep the premium. The data also smartly noted this served as a backdoor equity hedge if oil happened to break aggressively above $100 and drag the broader market down.
So what does this all mean for the average trader? It's like buying hurricane insurance during the hurricane. The premiums are so high that the actual payout becomes mathematically unlikely, but I want to make sure we represent the other side of this coin.
Right, when it works.
Because when this convex call buying does work in the semiconductor space, the leverage is almost unfathomable. The data provided some concrete examples of institutional flow that hit the jackpot this week, giving us a window into what happens when these massive, out-of-the-money bets actually connect.
The Flow Patrol data tracking these block trades reveals the sheer scale of the capital being deployed into the specific sector.
Let's look at the breakdown on Intel, INTC. The data flagged a massive block trade on April 24th. An institution bought 30,000 contracts of the Intel August 65 calls. The premium paid was around $22 per contract.
Which is a huge outlay.
Right. Fast forward to Thursday, Intel had ripped higher, trading above $94 a share. Those exact same August 65 calls closed the day valued at $92. That is a 400% gain over a matter of days.
But the percentages don't do it justice. You have to look at the notional dollar amount.
Exactly. Buying 30,000 contracts at $22 is a massive initial capital outlay. But closing them at $92 means the total premium value of that block exploded to $96 million.
To deploy that level of initial capital into a single out-of-the-money option strike requires a level of conviction that goes far beyond retail speculation. That is massive institutional money leveraging a deeply researched macroeconomic view on global semiconductor demand.
They identified a mispricing in the options chain and attacked it with size.
And Intel wasn't an isolated incident. The data tracked a nearly identical aggressive flow in Qualcomm, QCOM. An institution bought 25,000 contracts of the December 200 calls, laying out roughly $13 million in upfront premium.
Qualcomm reported earnings. The stock jumped 11% on Wednesday, and by Thursday, those leap calls were closed out for over 100% gains. The total premium value at the time of closing was $26 million.
When institutional desks see consecutive multi-million-dollar payouts on deep out-of-the-money semiconductor calls, it creates a feeding frenzy. It perfectly contextualizes why the Compass data showed SPY calls being so aggressively bid.
Traders are watching these asymmetric payoffs and rushing to replicate them across the entire Mag 7 complex.
But all of this localized euphoria in the options market doesn't just exist in a vacuum. Every single one of those Intel and Qualcomm calls being bought forces a mechanical reaction on the other side of the trade.
And this is where we have to lift the hood and look at the engine, because the actions of the market makers taking the other side of these trades create massive intraday forces that literally dictate the S&P 500's hour-by-hour movements.
This is the critical pivot from understanding what the market is buying to understanding how that buying structurally manipulates the index price. We have to dive into the HIRO data, dealer gamma, and algorithmic flows.
Let's start with HIRO, hedging implied return observations. It's a metric that tracks the cumulative delta of aggressive institutional options flow in real time. On Monday, the data shows the S&P 500 HIRO registered an absolutely massive $9 billion in cumulative delta.
$9 billion of directional options flow hitting the tape in a single trading session is immense. It forces structural shifts in markets plumbing.
And the composition of that $9 billion is what's truly fascinating. It was broken down into roughly $5 billion in put selling and $3 billion in call selling.
Now let's make sure we're translating this correctly.
Yeah, both of those flows are actually bullish for the underlying market, but for slightly different reasons. If an institution sells a put, they are expressing a neutral to bullish view, comfortable buying the dip. If they sell a call, they are technically expressing a neutral to bearish view.
Right.
But if market makers are the ones buying those calls from the institutions, the market makers now have to hedge their new position, which creates bullish buying pressure on the stock.
You've hit on the exact mechanism driving this market. Let's slow down and trace the exact path of a dollar through the market maker's hedging book, because it is the hidden engine of the S&P 500.
Okay, let's trace it.
Let's take that $5 billion in put selling. If a large fund aggressively sells $5 billion worth of SPX puts, there's a market maker sitting on the other side of the order book forced to buy them to provide liquidity. The market maker is now long those puts.
And a long put gains value when the market goes down.
Exactly. But market makers are not in the business of directional gambling. Their mandate is to remain delta neutral. They just want to collect the bid-ask spread. So to neutralize the bearish risk of holding those long puts, the market maker must immediately go into the market and sell S&P 500 futures.
Wait, if the market maker is dumping billions of dollars in futures contracts, doesn't that inherently push the S&P 500 index down?
It does, in the immediate microsecond aftermath of the trade. But here's where the dynamic feedback loop kicks in. Let's say the broader market catches a bid, maybe from the semiconductor sector, dragging everything up, and the S&P 500 starts to drift higher.
Okay.
As the index rises, those puts the market maker is holding become further out of the money. The probability of them paying out drops, which means their delta decreases. Suddenly, the market maker looks at their book and realizes the futures they sold earlier are now over-hedging their position. They're holding too much short exposure.
Ah, I see it. Because the puts are losing their potency as the market rises, the market maker has to unwind their short hedge to stay neutral.
Exactly. To flatten their book back to delta neutral, they are forced to go back into the market and buy back those short S&P 500 futures. That mechanical, forced buying pressure creates a massive tailwind that buoys the market, accelerating the upward drift.
And we saw this exact structural blueprint play out dynamically as the week progressed. On Thursday, the data tracked a very specific intraday shift in the HIRO flow. Early in the day, the cumulative delta was negative, but then it decisively shifted to positive.
And if you overlay the S&P 500 price chart over that HIRO data, the index tracks the flow upward almost perfectly.
Because the HIRO signal isn't just an abstract indicator. It is essentially reading the market maker's forced hedging blueprint in real time. When HIRO flips positive, it means dealer hedging flows are systematically buying the market.
Which brings us to the seek and destroy algorithm dynamic that was so incredibly prevalent this week.
Particularly in the 0DTE or 0 days to expiration option space.
The data explicitly details Thursday's EURDTE price action. Around 1:00 p.m. Eastern, a massive 99th percentile gamma level formed at the 7170 strike on the S&P 500.
To conceptualize a 99th percentile gamma level, you have to think of it as the center of gravity for the entire options market at that specific moment in time. It is the exact strike price where the absolute highest concentration of options exposure exists.
It carries an immense gravitational pull.
And right on cue, the price of the S&P 500 got pulled directly down to 7170. But then at 1:40 p.m., the data shows that massive gamma levels suddenly vanished from 7170 and shifted significantly higher, reestablishing itself at the 7200 strike.
And what happened to the index?
It acted like it was caught in a tractor beam. From 1:04 p.m. until the closing bell, the S&P ground relentlessly upward, eventually closing right above that new center of gravity at 7209.
That phenomenon is exactly what we call seek and destroy algorithmic behavior. It is a weaponized feedback loop.
How does it work exactly?
Well, large algorithmic trading firms possess the data to see these massive gamma concentrations building in real time. They understand the mechanics we just discussed. As the index price approaches a massive gamma level, the market maker's required hedging volume accelerates exponentially.
Right.
If dealers are short gamma at that 7200 level, it means as the price ticks up from 7195 to 7196, the dealers are forced to buy futures. The algos know this, so the algos aggressively buy at 7190, sparking a mini rally.
Which forces the dealers to buy, which pushes the price to 7195, forcing even more dealer buying.
The algos intentionally push the index into that strike to trigger an avalanche of mechanical hedging flow, effectively destroying the gamma concentration and forcing a massive transfer of risk.
It's essentially predatory trading.
Yeah.
The algorithms are using the market maker's strict mathematical hedging rules against them to force the market to a specific destination.
Yeah.
And the options market isn't just dictating the directional trend, it's also defining the absolute boundaries of the playing field. Look at the Captain Condor trade the data highlighted on Wednesday.
Wednesday was an FOMC day. The Federal Reserve was releasing its interest rate decision and holding a press conference. Historically, FOMC days are recipes for massive, unpredictable volatility.
But the data tracked a specific massive options trade place that morning. A roughly 3,000 lot 0 DTE iron condor established at the 7200 and 7060 strikes. Let's break down the mechanics of an iron condor so you listening understand why this matters.
An iron condor is a sophisticated, non-directional options strategy. You execute it by simultaneously selling an out-of-the-money call spread and selling an out-of-the-money put spread.
You are essentially drawing a box around the current stock price and betting that the market will stay inside that box, in this case, between 70.60 and 7,200 until the closing bell.
Your goal is to collect all the premium from those sold options as they expire worthless at the end of the day.
And the data points out that this 3,000 lot position was so incredibly massive that it instantly became the 98th percentile strike concentration on the entire 0 DTE board. A single institutional trade literally defined the absolute trading range for the entire FOMC session.
The market just ping-ponged harmlessly between 70.60 and 7,200 all afternoon, which is a profound testament to how heavily dealer positioning dictates our intraday reality.
The fundamental news of the Fed's rate policy was completely secondary to the structural boundaries established by that iron condor.
And the overarching theme governing all of these mechanics, the fundamental reason the market was able to absorb a $126 print on Brent crude oil without collapsing, all comes down to one structural condition: positive gamma.
The data states it unequivocally. Market makers are currently sitting in a state of long or positive gamma across the entire 6,900 to 7,300 range on the S&P 500.
Yeah.
This is the magic phrase. Let's explain why a positive gamma environment mechanically creates a buy-the-dip, sell-the-rip market that suppresses volatility.
It goes back to the delta-neutral hedging requirement. When market makers are long gamma, their forced hedging flow works in direct opposition to the prevailing market trend. If a terrifying news headline drops, say, a confirmed port blockade in the Middle East, and the market violently sells off, the delta of the market maker's long options book decreases. They suddenly become effectively short the market.
So to neutralize that unintended directional risk, they are mechanically forced to step into the open market and buy S&P futures.
Yes. So as the market drops, a multi-billion-dollar entity is mathematically required to buy the dip.
And the inverse is also true. If the market gets overly euphoric and rallies too hard on a great tech earnings report, their delta increases. They become effectively long. To neutralize, they must sell futures into the rally. They are constantly trading against the momentum, injecting liquidity to stabilize the price.
Exactly.
I love visualizing mechanics through analogies. Think of a positive gamma regime like the inflatable bumpers they put in the gutters at a bowling alley. You roll the ball down the lane, that ball is the S&P 500 index. Every single time the ball starts to careen toward the gutter because of a terrifying macroeconomic headline, it hits the bumper.
The mechanical force of dealer hedging.
Right. The bumper physically bounces the ball right back toward the center of the lane. And if the market gets too greedy and rallies too aggressively toward the other gutter, it hits the opposite bumper, and dealer selling pushes it back down.
That is a perfect visualization. As long as those positive gamma bumpers remain inflated, the ball is going to make it safely to the pins without ever falling into the gutter. The positive gamma regime literally forces mean reversion. It compresses the trading range and suffocates volatility.
But I have to push you on the logical conclusion of this analogy.
Yeah.
What happens if the air gets let out of those bumpers? Like, what happens if the market drops so far or options expire and the market maker's positioning flips from positive gamma to negative or short gamma?
Well, if the bumpers deflate, the entire architecture of the market changes. You are suddenly bowling on a freshly greased lane poised over a bottomless pit. If dealers flip to short gamma, their hedging logic completely reverses.
Meaning they trade with the momentum.
Yes. In a short gamma regime, when the market drops, dealers are forced to sell futures to hedge. When the market rallies, they are forced to buy. They act as an accelerant. They are throwing gasoline on the fire. A routine 1% fundamental sell-off mechanically triggers a wave of dealer selling that forces the index down 2%, which triggers more selling, turning it into a 3% rout.
Which is the absolute nightmare scenario for equity bulls.
Yeah.
And this structural fragility hidden beneath the surface brings us perfectly into the next major theme of the week: the volatility disconnect.
Because this artificial bumper car environment created by positive gamma leads directly to the most baffling, historically anomalous data point in the entire week's data set.
The absolute comprehensive collapse of broad market volatility metrics in the face of escalating global risk. It is genuinely hard to wrap your head around when you look at the raw numbers. We have Brent crude touching 126. We have the Strait of Hormuz dominating international headlines.
We are navigating the most consequential Mag 7 earnings gauntlet of the year.
And yet, the VIX, the CBOE volatility index, the literal cost of portfolio insurance, closed Friday at 17. The data explicitly notes that the VIX front-month future is trading at post-war lows. Meanwhile, beneath the surface, the VVIX is sitting up in the mid-90s.
We need to define VVIX because the divergence between those two metrics is telling a massive story.
Yeah, go ahead.
The VIX measures the expected volatility of the S&P 500. The VVIX measures the expected volatility of the VIX itself. It tracks how fast the price of insurance is fluctuating.
Okay, so a VIX at 17 paired with a VVIX in the 90s means that while insurance is currently cheap, the market makers selling that insurance are incredibly nervous about how quickly the environment could change. They are pricing in the potential for an explosive repricing of risk.
It is a profound divergence between the geopolitical reality of the world and the mathematical pricing of risk on Wall Street. But the most shocking data point in the entire spot gamma packet isn't even the VIX.
It's the Core 1M data from Tuesday, the CBOE Correlation Index. The notes explicitly state that historically, whenever this specific metric drops below a reading of 8, they strongly recommend aggressive downside hedges on the S&P 500. On Tuesday, amidst all this chaos, the index dropped to 9.
If we take a step back and connect this to the bigger picture, a Core 1M reading of 9 is a massive blaring siren. It is the skeleton key to understanding the bizarre behavior of the entire market dynamic right now.
Let's unpack correlation. If we have an index at 9, what did that actually look like inside the S&P 500?
Correlation simply measures how closely the individual stocks within a broad index move in tandem with one another. If every single stock in the S&P 500 goes up 1% on the exact same day, correlation is extremely high.
Right.
If half the stocks go up 2% on great earnings and the other half go down 2% because of an oil shock, correlation is incredibly low, approaching zero.
They are canceling each other out.
Exactly. A CAR 1M level of 9 means that correlation across the U.S. equity market has essentially vanished. The stocks inside the index are moving completely independently. NVIDIA and ExxonMobil are effectively trading in alternate realities.
The data explains exactly why this structural fracturing is happening. Institutional traders are aggressively bidding up single stock call options, specifically concentrating capital in the Mag 7 and semiconductors, while simultaneously shorting or selling index-level volatility.
It's the barbell strategy manifesting in the derivatives market. They are buying NVIDIA lotto tickets and paying for them by selling S&P 500 straddles, betting the broad index won't move.
Because the earnings and the capital expenditure guidance in the semiconductor space have been so spectacular, global capital is aggressively crowding into a very small handful of specific names. Those individual stocks are experiencing massive idiosyncratic volatility. They are moving wildly.
We just talked about Intel returning 400% on a call option and Qualcomm jumping 11% in a single session. That is extreme volatility.
Yes, but here is the trick. Because the rest of the market isn't participating in that tech euphoria. Remember our basis point math earlier. The other 490 stocks were a net drag on the index. The massive volatile gains in the tech sector are being perfectly offset by the slow, grinding stagnation or outright declines in the other sectors.
The sectors that are being actively suffocated by $126 oil.
I want you to visualize this dynamic. Imagine a massive flock of 500 birds flying through the sky. If a predator attacks the flock, all 500 birds suddenly dive sharply to the left together in unison. That is high correlation, which creates high macro volatility. The whole mass moves violently.
Right.
But what the market looks like right now is a flock of 500 birds, where 10 of them have suddenly ignited rocket boosters and are shooting straight up into the stratosphere, while the other 490 birds are just lazily circling in place or slowly drifting down toward the ground exhausted.
That's a great image.
If you just look at the average height of the entire flock, which is exactly what the S&P 500 index measures, the average height looks completely flat and stable. The index barely moves. It looks incredibly safe.
That is an exceptional way to frame the math. The surface of the water looks dead calm, but underneath, there are incredibly violent, churning, opposing currents. High single-stock volatility in tech, combined with historically low correlation across the board, equals low broad index volatility. The math cancels itself out. That is exactly why the VIX can sit at 17 while oil is at wartime highs.
But the data is waving a massive warning flag here regarding this low correlation. The analysis asks a very dark question. What happens when this precise, delicate positioning unwinds?
Yeah, that's the scary part.
The notes make it clear that the current structural positioning, if it is forced to shift from bullish leaning and volatility suppressing to an immediate need of downside protection, can and will cause an incredibly violent market reaction.
And if you understand the plumbing, you can see the exact mechanism for that violence. The entire market structure right now is precariously balanced on a single assumption: that mega-cap tech stocks will continue to absorb endless capital, and that index volatility will remain artificially suppressed by dealer gamma.
Everyone is crowded onto the exact same side of the boat. They are overwhelmingly long tech calls and dangerously short index puts.
So what is the catalyst that forces everyone to run to the other side of the boat?
Ironically, it might not be a geopolitical event at all. The market has already proven this week that it has the capacity to ignore a $126 print on oil as long as the AI narrative remains intact.
The trigger for the unwind would likely be a fundamental failure originating from within the tech sector itself. If a major semiconductor earnings report genuinely disappoints, or if forward guidance on AI infrastructure spending is significantly lowered, those massive, expensive, high IV call positions we discussed earlier will suddenly have to be liquidated.
The rush for the exits begins. The music stops.
Exactly. Institutional traders will aggressively sell their single stock calls to salvage whatever premium is left before the volatility crush wipes them out entirely. That concentrated selling creates intense, immediate downward pressure on the mega caps that hold the heaviest weight in the index.
Right.
At the exact same time, because correlation is sitting at that historic low of 9, any sudden macro shock that causes the tech leaders to drop alongside the already struggling 490 other stocks will cause correlation to spike violently.
To use the analogy, the rocket boosters on those 10 birds fail, and suddenly the entire flock of 500 is diving toward the ground together.
And when correlation spikes, broad index volatility spikes with it, the math reverses. All those traders who have been collecting premium by shorting the VIX and selling S&P 500 index puts will suddenly find themselves deeply underwater, facing massive unhedged losses.
They will be forced into the market in a panic to aggressively bid up index puts to protect their portfolios.
And we know exactly what happens when massive put buying hits the tape. As institutions buy puts, they force the market makers on the other side of the trade to aggressively short S&P futures to hedge their risk, which mechanically accelerates the market's decline.
The positive gamma bumpers in the bowling alley completely deflate. The lane gets coated in grease and the ball goes straight into the gutter.
That feedback loop is the hidden structural vulnerability masking itself beneath a VIX of 17. The broader market isn't pricing in the risk of a catastrophic unwind because the positive gamma environment is acting as an anesthetic, numbing the system to its own fragility.
Which brings us to the Friday wrap-up and the key levels we need to map out for the week ahead. Bringing all of these complex themes together, the completely ignored macro risks, the concentrated tech euphoria, the artificially suppressed volatility, and the hidden structural fragility. Where does the dust actually settle as the week comes to a close?
If you just look at Friday's closing prints, it paints a picture of absolute resilience. The S&P 500 closed at 7230.
It held firmly above the massive 7200 call wall.
Exactly. For context, the call wall represents the specific strike price in the options chain that holds the largest net call open interest. Historically, it acts as massive upside resistance, a ceiling where dealer hedging flows naturally suppress further rallies.
But the bullish momentum in tech was so strong that the market simply chewed through that resistance and managed to close above it. The QQQ, representing the NASDAQ 100, closed strong at 674. Even the IWM, the Russell 2000 small cap ETF, managed to close at 279.
But the most revealing metric to track is the evolution of spot gamma's risk pivot throughout the week. The risk pivot is their line in the sand. If the index is trading above it, the structural dealer positioning implies a bullish environment.
Right.
If the index breaks below it, it implies a dangerous shift to a short gamma bearish environment. On Monday morning, that pivot started all the way down at 70.90. By Friday afternoon, after chewing through all of this intense data, the earnings volatility, and the price action, they raised the risk pivot to 7.80.
Raising the structural risk pivot by 90 points in a single trading week is a massive adjustment. It tells you that the entire dealer support base, the floor of the market, has actively shifted higher following the price.
The positive gamma environment is literally dragging the structural safety net up with the market. However, it also means the trap door is now much closer. If the market were to break below 7,180 next week, it wouldn't just be a technical breakdown. It would signal a material mechanical failure in the dealer support structure.
And I want to highlight one final incredibly notable options flow from Friday that really perfectly encapsulates the underlying sentiment we've been discussing for the past hour. Let's look at Alphabet, Google.
Oh, the put selling.
Yes. The data observed massive, highly unusual put selling activity hitting the tape. Specifically, an institution came in and sold 6,000 contracts of the Google December 350 puts, collecting approximately $51.10 in premium per share.
We have to do the notional math on a trade of that size to truly appreciate the conviction behind it. Selling 6,000 put contracts means that the institution is legally obligating themselves to buy 600,000 shares of Google at a strike price of $350 a share if the stock happens to drop below that level by the December expiration.
If you multiply that out, they are taking on a $210 million notional commitment.
They are putting $210 million of capital on the line. But look at the premium they collected for taking on that risk, at $51.10 per share across 600,000 shares.
They collected over $30 million in pure cash premium upfront, deposited directly into their account on Friday just to take on that obligation.
What does a trade like this mean practically for the ecosystem? Why would a sophisticated institution utilize capital this way instead of just buying the stock outright?
It accomplishes two major goals, utilizing extreme capital efficiency. First, they are aggressively harvesting elevated premium.
Even though the
VIX is low, the implied volatility on specific tech megacaps like Google is still relatively rich.
The institution is acting as the insurance company, stepping in to underwrite the risk and collecting a massive $30 million premium check for doing so.
Second, and much more importantly regarding market sentiment, it means they are perfectly willing and likely eager to own Google stock at an entry price near $350.
Yeah.
By collecting $51 in premium upfront, their actual mathematical break-even cost basis, if the stock crashes and they are assigned the shares in December, is just $299 a share.
Wow, so they get handed $30 million today to generate yield, and in the absolute worst-case scenario where the market tanks, they're forced to buy Google at a massive structural discount to where it's currently trading.
Precisely. It is a sign of immense underlying fundamental confidence in the tech bid. It proves that institutional capital isn't solely engaged in buying highly speculative short-term lottery tickets on the upside. Massive funds are actively willing to underwrite massive long-term downside risk because they fundamentally believe in the valuation floor of these specific mega-cap technology companies.
They believe the AI moat is impenetrable.
So, to synthesize this incredibly complex, deeply contradictory week into a cohesive summary, we navigated a week defined by severe, escalating geopolitical tension, a terrifying $126 print on Brent crude oil, and massive, volatile earnings reports from the most heavily weighted companies on Earth.
But despite all of those fundamental macro shocks, the positive gamma environment engineered by market maker positioning held the broad index incredibly stable.
The mechanics heavily rewarded the traders who correctly identified the convexity in the semiconductor space and deployed capital into call spreads early, like those Intel and Qualcomm Flow Patrol winners.
And it brutally systematically punished anyone who bought broad index puts expecting the scary geopolitical headlines to crack the market's armor.
It truly served as a masterclass in why modern market participants must learn to trade the underlying mechanical structure, not the news cycle. The front page of the newspaper screamed sell, but the dealer gamma profile and the HIRO flow data screamed buy the dip. The plumbing always supersedes the headline.
Which perfectly ties all of our key themes together. The market is currently being held aloft by a historically concentrated bid in technology and semiconductors, combined with an ironclad dealer positive gamma regime.
This specific combination is acting as an impenetrable mechanical shield, completely insulating the broad indices from the very real, mathematically quantifiable economic threat of $100+ barrel of oil and soaring inflation expectations.
It is a delicate, highly artificial equilibrium. The structure is strong, but it is deeply reliant on a very narrow set of variables remaining constant.
And that leaves us with a final provocative thought for you to mull over as you analyze your own portfolios this weekend. Something that builds on the mechanics we've discussed, but looks just over the horizon.
What happens when it breaks?
Exactly. We've spent this entire deep dive breaking down how positive gamma acts as a shock absorber for geopolitical crises. We've seen firsthand how the market can mathematically ignore missiles, blockades, and oil shocks. But knowing that the market is structurally positioned only for upside, knowing that the VIX is at post-war lows, and knowing that index correlation is sitting at historic single-digit extremes, what happens to a market priced for absolute perfection if the AI growth narrative actually stumbles?
It's the ultimate systemic blind spot. Everyone is looking outward for the catalyst, but the true vulnerability is entirely internal.
Exactly. It wouldn't be a geopolitical headline in the Middle East that breaks the market. The market has proven mechanically that it can absorb external trauma. The fatal blow would come from inside the house.
It would be the very sector currently holding the entire index afloat. The semiconductors, the Mag 7 failing to deliver on the astronomical decade-long growth assumptions currently priced into those 40% IV call options.
If the weight-bearing pillar of the market cracks, the low correlation reverses, the gamma flips short, and the entire structure comes down on itself.
A sobering mechanical reality for a market resting at all-time highs.
And with that, we want to thank you for joining us on this deep dive. Keep a very close eye on how price interacts with that 70-180 risk pivot, and watch those key gamma levels next week. See you next time.